I had a mentor in the tech company that I was working in who had tech background, but he had worked in insurance industry. So he knew who actuaries were. And I'm talking about 2006, 2007 time. To put things in context, there were about only 200 actuaries in India then. So not many knew about the profession.
Many things still did not change, right? If you see the fire insurance per mil rate is a standard, right? It's remained standard across the industry, and very marginal change happens everywhere, right? I think so. It's not changing very fast, right? I think that's what. And things are changing very fast as well, right? I mean, previously unexpected thing used to come at a level of decade, right? Now every 3 year or 4 year we see something unexpected, right? World is changing so fast, right? I mean, so that also is happening, and evolving these things is also a good challenge of industry actually. Hello everyone, welcome to InsurTech Voice, and today we have a great speaker, Sumit Ramani, who is carrying more than a decade of experience in industry. So Sumit, welcome to InsurTech Voice, and I'd like to know more about you.
Thank you, Hitul, for inviting me. Bit of background, I'm a computer science engineer turned actuary. Been in the insurance industry for about 18 years or so. Spent first few years of my career in IT department of an insurance company, and then moved to actuarial side of things. I've been on my own for about 8 years. I run two businesses. One is actuarial consulting, focused on insurtechs, and we have clients pretty much across the globe. And second is a tech startup called ProtectMeWell, which is an API-first comprehensive financial planning engine. It's a B2B SaaS play. We license these APIs to insurance brokers, insurance companies, wealth advisors at this point in time. On book, I've written a book called Ring of Fire. It was published a couple of months ago. It's on financial independence, retire early, where I'm arguing that retiring early is not necessarily a good idea. And FIRE should be seen as a journey and not a destination. A journey where you increasingly do more of what you like and less of what you don't. And that's essentially one of the core themes of the book.
Well, that's great. And I think it's very rare combination we see. So actually is having a technology degree, right? That's great. So my question is, how come you switch your career from a computer engineer or software engineer to a actuary? That's very strange transition, but yeah, how you came across that?
So I graduated as an information and communication technology engineer from DICT. But then my interest was always in maths. In third year of my course, I took a optional course called Methods of Optimization, which is essentially operations research. And that's where my interest in applied maths kind of rekindled. I tried looking for things that I could do on the math side of things while I was still in the college, but couldn't find anything relevant. So took up a job that I was offered to do as part of campus placements. But the quest to find something which is more focused on applied maths continued. And I was reading one of the magazines, found an article on actuarial science as a profession, and everything about it just made sense, right? So maths, applied maths, you don't have to go to college, which I did not want to. Although it said that it's very hard to qualify, but I was 21, had found my mojo again. I thought, what could be difficult for me? And hence I started thinking of pursuing it. Then I had a mentor in the tech company that I was working in who had tech background, but he had worked in insurance industry. So he knew who actuaries were. And I'm talking about 2006, 2007 time. To put things in context, there were about only 200 actuaries in India then. So not many knew about the profession. So he knew about who actuaries were, and he said, actuary ban jao, life ban jayegi. So then I said, okay, maybe that's one thing I should do. I should pursue it. Around the same time when I discovered this, a friend of mine had joined one of the life insurance companies in their IT function as a business analyst. And they were hiring for their team. He reached out to me to see if I would be interested. By then, I had figured out actuaries typically work in an insurance setting, and I thought this could be a nice transition. So I switched jobs, moved to a life insurance company in their IT function, started writing exams. Every time I would qualify for clear an exam, I would reach out to the actuarial team and share my interest. The transition took about 3 years. By then, I had cleared 6 exams, 6 out of 15. And once the transition happened, things became a lot more easier because I was actually applying what I was studying.
True.
And then took me another 6-7 years to qualify. During this, I worked in the same life insurance company, and then also worked with a reinsurer. So yeah, it's basically the interest in maths and things falling in place and a dash of luck.
So I mean, yeah, I mean, also your journey and your passion, like connected actually. So that's a great thing. So why just insurance you focused? I mean, actuaries also work on other fields as well, right? Why you stick with insurance only?
Yeah, so while a large part of what I do is quite insurance focused, but there are a couple of things that I've done beyond insurance as well. So in fact, I had a client on the consulting side of things who were a gaming company.
Oh,
So think of gaming and insurance, they're very, very similar, right? In case of insurance, you are paying a premium for an event that you don't want to happen,
right.
right? In gaming, you are entering a game with a hope that you win the jackpot.
Right.
But the underlying maths are same.
Right.
The ways probabilities are stacked are very, very same, are very, very similar, and the house always wins, right? So
Right.
in this case, the insurance companies eventually make profit. In the gaming setting, the house always wins, right? So I've applied my skills in industries beyond insurance as well. But it's also about the acceptability, right? So the world still sees actuaries as insurance guys. And that also is one of the reasons why most of my work is insurance focused, but I've dabbled outside as well.
Oh, that's great. That's great. So, I mean, based on your experience, what do you think? How an insurance company and actuaries work together?
For an insurance company, actuaries are really the core part of what they do, right? So the products that insurance company make are designed and priced by actuaries. Once these are sold, claims would come, and the estimation of what the claims would look like is also done by actuaries. So while most people do not know who actuaries are, but actuaries sit at the heart of an insurance company. And of course, there's a lot of regulatory roles around that actuaries perform. But from the product and what happens to that product after the sales has happened is something that actuaries play a very, very crucial part. To that end, actuaries are very relevant in insurance setting.
Right. So when you are working with insurance companies, do you get to see all the different units of insurance company like underwriting, distribution, claims, risk, everything you get to see, or no? I mean, that's something you never see when you are designing a products or building a pricing for products.
Yeah. So actuaries perform two crucial roles, actually three crucial roles in an insurance company. One is pricing the product. Second, valuing the liabilities. And third is called experience studies, which is essentially saying you assume that, let's say, 5 people out of 1,000 would die who are in the age bracket of, let's say, 36 to 40, but only 4 died. You assume that 3 people out of 100 would lapse, but only 2 lapsed, right? This you study for an extended period of time and come up with assumptions. So that's the experience studies. The actuaries who focus on pricing side of things, which is where my most time was spent when I was in a life insurance company, by definition have to work with distribution, because distribution team would come up with what their end customers want.
Right.
They would want to design the products in a way that is sellable.
Right.
While you have to do pricing in a way that it's sustainable.
Right.
Right. So you work with distribution. If the product is sold, underwriting would also happen, and pricing, how stringent the underwriting is, would define how the pricing would be. So you also work with underwriting team. You work with IT team as well, because once the insurance product is created, it has to be set up in system, and by definition, these products are very, very complicated and require help from actuarial team to ensure that these are correctly configured in the systems. So you work with IT team as well. There are some instances where you also work with claims team, because if the claims underwriting is not in place, it would eventually impact the profitability and the premium. So you also work with claims. You certainly work with marketing team, because the product eventually has to be marketed. There has to be a communication around it. So you also work with marketing team. So you pretty much end up working with all important functions of a
You are at the intersection of all the units of insurance company. So, no, I mean, that's great. Do you see insurance companies should work differently when they are hiring an actuary, or you feel it's right already in the industry?
I think there's no clear answer, and the answer also varies from geography. So insurance companies work under the premise that they have to fulfill a promise at a future date. They're also regulated because of right reasons, because ultimately the policyholders need to be protected. So as an actuary, you need to strike a balance between the policyholder, the distributor, or let's say your stakeholder, which is shareholder, and also the regulator. So you're already quite constrained in what you could do.
Right.
So the boundaries get quite defined. What you could do within that boundary then becomes constraining, right? So, and I think that's a design part of the insurance industry. So as an actuary, you can't be super innovative, because being super innovative could also mean substantial losses, could also mean impact on solvency of an insurance company. So it gets a bit tricky. But yeah, insurance companies could certainly do a lot on technology. And some of this could also mean innovation in products where actuaries could play a lot of role.
Okay. And what do you think? What are the key problems, nowadays in the industry that actuaries face whenever they design a pricing? It can be data or whatever. I mean, what problem do you see in general?
I think data is now less of a problem. What I see, the challenge is really to strike a balance between it should be sellable, it should be profit generating, and it should be compliant, right? So
you will have to see a competition as well, right?
Competition as well, right? So with all these constraints, there's the challenge really is in coming of a product which is relevant, would sell, would make profit, would be compliant. You can't do much of innovation, so that's a bigger challenge. However, you could do a lot of innovation on, let's say, how you source data, and that's on the sales side of things. How you underwrite, that could also be something that could be looked at. Equally, how do you process claims, right? So, and all these would eventually come back to pricing. So the challenge is limited innovation because of the constraints that you have, but you could try and experiment with loosening one of the constraints. Like, can you do an underwriting without asking all the questions that you asked today and still not compromise on risk?
Right.
So can you come up with new ways of underwriting wherein you are probably regularly underwriting an end customer and have a greater feel for what the risks look like? So those things need to be played around with, but the underlying mechanism or mechanism still remains same. How do you play around with things which make the customer life easier while still ticking all the boxes that you're required to, is I think where the innovation should happen.
And I think that's the reason I think many things still did not change, right? If you see the fire insurance per mile rate is a standard, right? I mean, it's remained standard across the industry, and very marginal change happens everywhere, right? I think so. It's not changing very fast, right? I think that's what we can say, right?
Yeah. So in fact, if you look at when I started, let's say about 20 years ago, the products that were being sold are still the same products that are being sold, right? Small innovation here and there, but that's really about it. But there are two parts to it. One, the core risks are already covered, right? The risk around, let's say, life, health, critical illness, motor, from an individual perspective, motor, home, they're already covered. From a business perspective, fire is covered, right? So the core risks are covered. But with time, the risks are also changing their form and shape. For example, let's say if self-drive car becomes a reality, right? Then the accidents are likely to be very, very less. But there is now a risk that someone could hack into your car and play around with it. So the risk would get transformed, and someone will have to spend time and effort to build a product around it, keeping this in mind. There are new risks that have emerged which were not there, right? So in a world where everyone was working for, let's say, government, the job loss risk wasn't there. Now it is all the more relevant.
Yes.
But there are no products around it because maybe there's not enough market for it. And an insurance company, given the scale and they work with, unless the market size is big enough, it's very, very unlikely they would come up with new insurance products. And that, I think, continues to remain a challenge. And that's also one of the reasons the products that exist haven't quite evolved in last so many years.
So if we take example of COVID, let's say, right, that was also very, very, breakthrough, right, big breakthrough. So do you see, I mean, that event was actually thought of, in past when products were designed, or it was a very unpredictable thing happen and loss ratio just just goes for toss actually.
So in some sense, if you look at it, some policies had the clause that the risk would not be covered in case of pandemics, right? So,
but even before
COVID,
so they predicted this.
So they did not predict, but this event has happened 100 years ago, right? And the insurance industry is significantly older than that. So over a period of time, the insurance industry has evolved, and they know what risk can wipe them off, and those are the risks they would not want to cover. So if you look at some policies, already said the pandemics would not be covered.
And things are changing very fast as well, right? I mean, previously, unexpected thing used to come, at a level of decade, right? Now every 3 year or 4 year we see something unexpected, right? World is changing so fast, right? I mean, so that also is happening, and evolving these things is also a good challenge of industry actually.
So the world is changing at a very fast pace, and my belief is that the risk never goes away. The risk always transforms. So if you look at it, all the innovations that have happened have two primary core themes around them. One of them is to make our life more convenient, and second, to ensure that we do not die sooner. We live longer, basically.
Right.
From cars to aeroplanes to the medicines that we're talking about now, everything around it has two common core themes, right?
True.
Which also means that, but if you look at it, let's say if you were a hunter and gatherer living in a jungle, you could die because a tiger eating you up or a snake biting you. So now we no longer live in a jungle. We live in houses which are safe, but we drive cars.
Right.
So the chances of you meeting a car accident still remains there. It's significantly lesser than you being eaten by a tiger, right?
Right.
So the risk has now changed.
Yes.
It's no longer tiger, but it could be someone else's car. It could be a plane that you're flying in. It could be a lift or elevator that you use malfunctioning.
Right.
It could be, let's say, a device that
lift, right? I think. I mean, we came via lift, right?
Yeah.
I think even that may malfunction.
Right?
So it's a day-to-day life.
Yeah.
Right. I mean, previously, 2 decades back, having a lift in a home was also a big thing, right?
Right.
It's quite common.
Yeah. Even let's say poisonous gas leaking from a factory, right?
Yeah.
So these risks were not there.
Yeah.
The risk always changes forms, and hence, as an actuary, you also need to be kind of evolving to be able to evaluate those risks.
Right.
And rethink of the products in the light of how risks have been evolving. So to that end, I think actuaries will continue to remain relevant in one sense, but also would need to be able to more close to how the world is evolving to be able to understand those risks, price those risks, and mitigate them eventually.
Right. This AI is also, like it's disrupting right now, right?
Yeah.
And yesterday only we saw some breakthrough from a cloud, right? I think like. So, what do you think of the world after AI? What will be impact on the world, specifically on the insurance side?
So again, major breakthroughs that happen would make something which was scarce earlier basically now more abundant. So in the world of internet, the data became more abundant. Eventually, the information became more abundant. With AI, now intelligence is in abundance. If I were to learn something, I can open a chat GPT, a Grok, and learn something very, very quickly. But what remains scarce at this point in time is judgment. How do you know that what ChatGPT or any LLM model is throwing is relevant for you, is correct, is not biased because it's trained on a data which is not contextualized for your purpose?
Right.
So the judgment then becomes important. How do you ask the right questions? So knowing things from first principles still continue to remain relevant. So yes, the world would evolve, the world would change. And with AI, I think our ability to ride on AI, apply our judgment would become more relevant. It will impact every industry, and insurance industry is not going to be an exception. There are already some early signs of it, right? So now, let's say if a CEO had to write an email which was of a certain tone, it would require a lot of effort. Now you don't need that, right? You can do that in 5 minutes. If I were to, let's say, review a legal document, I can the legal document on Grok and say, okay, tell me what are the risks that I should be aware of, right? If I were to do a proposal for a client, I can give few prompts and the proposal ready in 5 minutes. Right? If I were to write a code, you have coded, I have coded in past. There were days when you would get stuck on one small problem for days, but now you don't need to.
Yeah.
It happens in 10 minutes, 15 minutes, 20 minutes. So what used to take 8 hours would happen in maybe 1 hour, right? So there's already some bit of efficiency gain that we see that are happening as we speak, which would mean that now lesser people with the same skills would be required.
Right.
Which that's one part of it. The second part is that if there is an efficiency gain, from a product perspective, it could be cheaper, right? Because the expenses have now lowered. So people who, of course, will have to ride on those technologies, but efficiency gains are bound to happen. Would people lose job? Maybe, yeah. But yeah, I think those who still can think from first principles, can apply judgment, I think they would continue to remain relevant.
Everybody will have to learn, right? Yeah. Will have to reskill themselves, right? Yes. Things like restarting your career, that kind of moment, it may be going forward with the AI. But AI will bring in new kind of risk as well, right? I mean, everywhere, right? In the insurance as well. Maybe you are doing KYC, but I think your defect is there, right? I mean, and how will you identify? Because now AI is generating almost real life AI, right? Even I generated my AI clone and it's able to mimic me 100%, and even my voice is getting cloned, right? So by seeing a video, nobody can judge that. Is it a real Hitul or it's a clone of Hitul actually generated by AI?
So I think in a steady state, all risk would eventually become a liability risk because everything would be, let's say, done by AI. So is the AI malfunctioning, that would become the risk, right? For example, let's say you now have a clone, right, who does, let's say, records a video for you. Whether because of that video, could there be any loss to your company?
Right.
Is the risk that you have now, right? And that becomes a liability risk. So I, in fact, wrote an article some time back that eventually, when everything would be done by AI, the risk would then be AI malfunctioning or not doing its job well, and then that leading to losses. But we're like several years apart from it. But that's where things are heading.
So some US company, I also read somewhere that one of the US company also added a clause in their policy that, okay, AI risk is not covered actually.
Yeah.
So yesterday only I saw somewhere that so AI had a full access. It spent 2500 USD somewhere actually. I mean that's something is insane. Now whether insurance company will pass this claim or no, that's a different story. But that's a risk, right? In the end, right? And LLMs are black box in nature, right? I mean, you don't know
Right.
why it gave you this judgment, right? So yeah, I mean, it's a very, very unique kind of risk actually.
Yeah. And like for our insurance companies, right? Unless they understand the risk, they don't want to write it, and fair for them, right? So AI, as from a risk perspective, is evolving.
Yeah.
Hence, so if you write a risk that you do not understand, there are only two ways to do it. One, that you increase premium so much that it covers the extreme scenario, but then it becomes unaffordable.
Yeah.
Or second, you keep the premium competitive but be open to losses. Right? So both are not something that most insurance companies would be willing to do.
And even AI is evolving so fast, right? I think a quarterback which was sounding impossible after a quarter, it's sounding it's possible now, right? Basically.
Oh.
So how can you see a future for next 5 years, right? Where we will be?
For example, AI, I think at this point in time, still has a kind of median intelligence. So it's a combined intelligence of everyone on the earth. Right? So by definition, it has median intelligence.
Right.
But I'm sure over a period of time, it would get to 75 percentile, 90 percentile, 95 percentile, and then it would become all the more powerful.
Right.
But from journey to median, that is 50 percentile to 95 percentile, could happen very, very fast.
Right.
We just don't know. I mean, it could happen in a year or two. Right?
Yeah, I mean, like might see. Now, I would like to know about your journey in distribution because you're also running a company called ProtectMeWell, right? And there you're solving certain problems in a distribution, right? So maybe if you can share insights on the same.
So when I was starting on my own in 2017, obviously my medical insurance cover would have gone away, and my wife was already pregnant, right? So I knew that I won't be able to claim. But for me to be able to find a right product and right size of it, I did not have an easy answer to it. Let's say even if I identify right size of the cover for medical insurance, finding a right product wasn't easy. So I spoke to someone who was product head in one of the insurance company and asked, how do I go about it, right? He spent an hour helping me understand how do you evaluate a medical insurance product in Indian context. And towards the end of the conversation, I asked him, which product should I buy? That's how human mind is, right? Human mind needs an answer, an actionable insight. Yes, some people are more curious than others, but most people need an answer to action upon. And that was one seed that was sown then. Second, when I spent few years on the consulting side of things, made some money, and started thinking about what should be my retirement corpus. And there was no easy answer to it.
So I think you like something like this, right? 10x of your annual income or those numbers we get, right?
We'll talk about that as well. So there's no easy answer to it. How much should be medical term insurance? People say 10x, and I think that's not how it should be. We can talk about that as well. So I thought that someone like me who understands the maths, who understands what does it take, doesn't have an easy answer. Chances are that many more people would not have an answer. So one, there wasn't an independent way of identifying the size of your covers. And second, if once you have identified the size of the cover, identifying product was even more a nightmare, given there's so many products doing so many things, right? So they're not comparable in
covers for each person will be different, right?
Yes.
For me, my lifestyle is not that lavish, or maybe I'm living a simple life. It's a different cover amount for me, and maybe for you it might be different amount.
So that's when we started thinking about ProtectMeWell, and we thought about it should be hyper personalized. It can't be 10x into annual income, because that logic fails. Someone who is extremely rich, has a substantially high net worth, there's no point for him buying a term insurance which is 10 times annual income, because his assets can take care of him, right? So how do you think about it from first principles. So talking about term insurance, your term insurance should essentially be able to cover for all future expenses of your dependents, right? In case the event happens, plus any outstanding loans or liabilities that you might have. But you should also adjust it for income that comes from secondary source of income, which are passive in nature, let's say dividends and rents. Because those would continue even if, let's say, you are not around. Over a period of time, you could have also accumulated assets, and those can also be used for maintaining the lifestyle. So there should be 4 components. Actually, 5th component is the cash flow, which I'll talk about in a bit. So 4 components are future expenses, outstanding liabilities, income from secondary sources, and the assets. Even if you do all of this right, there could still be challenges when the cash flows are not aligned. And we can't make a simplifying assumption that someone who is a beneficiary of my term insurance policy is like a fund manager. It's like a geek in financial products. If I give him or her a certain amount of money, he or she would be able to manage that so that the cash flows are also managed.
Right.
So you also have to kind of see whether there would be any instances when the cash flows are not aligned.
Right.
So you should then consider jacking up the term insurance to that amount. So that's how you look at term insurance. But if you look at retirement corpus, it's exactly the same model, but looked at a different point in time. So you're saying, okay, I want to retire at 60. All I need to do is take care of all of my future expenses and my dependents, right? But between now and time 60, your lifestyle would have changed. Your life stage would have changed, which means that someone who was dependent on you at age 30 may not be dependent on you at age 60. So that has to be accounted for. So we built an engine which accounts for your income, expenses, assets, liabilities, life stages, and lifestyle changes.
Right.
It's the same model, but we now look at a different point in time to arrive at size of cover for, let's say, term insurance, medical insurance, critical illness, home insurance, retirement corpus,
health insurance,
all of that. Since it's in the same model, being looked at different point in time, it's internally consistent.
So it's a customized for all, right?
It's customized for all.
One for all. Right?
It's not. It's the engine is same, but the assumptions are basically aligned to who you are or your profile.
And maybe your actuary experience must have helped you to design this in a better way.
Yeah, doing it from in a way which is from first principles, which makes sense, looking at from different angles. For example, right, one way to look at it, one of the challenges that I had before doing ProtectMeWell was some of the insurance companies had a term insurance calculator and a retirement corpus calculator, right? If you look at it, there is a strong correlation between the two. The size of your term insurance is retirement corpus of your dependents. Right. So most people, when you ask them how much do you need for retiring, they would say 8 crore, 9 crore, $1 million, right? And most people, if they buy term insurance, they will buy it for 1 crore. So are you in a way saying that those 7-8 crores, that is 9 crore minus 1 crore, was meant towards your expenses?
Right. I mean, yes.
Yeah. So since these calculators in most cases are different, they do not talk to each other. They are internally.
And world is also changing so fast, right? And the inflation is changing.
Yeah.
Right? I mean, your maybe one asset was working fine in past, but after 5 years, that same asset is not working, right? I mean, so yeah, I mean, the corpus needed right now maybe is X, but you don't know after 10 years, 20 years what will happen, right? So yeah.
So those calculators probably did those inflation adjustments and stuff.
So okay,
but they were not internally consistent. And hence, that's also how people perceive it, right? They're happy with 1 crore term insurance, but when they need retirement corpus, they need 9 crores, which essentially means that there's a huge difference between the two scenarios.
But tax is also there, right? I mean,
so we do all of that, and it's also internally consistent. So in our case, retirement corpus would always be higher than your term insurance. Required retirement corpus, you could have assets, which is fine, but what is that you need is always going to be higher than term insurance. Your disability cover would always be higher than your term insurance, because in case of term insurance, your income stops, your expenses also stop.
Right.
But in case of disability, your income most likely stops, but expenses increase.
Right.
So if you're disabled, you need more money than you die.
Right.
Right? But this is not how people think about it.
Right.
Once we thought about it, while we built it from first principles, and then we started to make sense out of it, all these just added up.
Right. No, I mean, that's a unique problem you are solving. And one more challenge I have seen is like people are also, not all folks are that much knowledgeable to design and also thinking through all the things, right? I mean, just not just insurance, but also your retirement and other factors. You need one guy who is knowing all of those things, right? I think that's also something is very rare, right? I think to find such kind of folks like who can design a thing and just customize it for you, right?
Yeah. So I think if you keep customer at heart and do not get constrained by, okay, I'm a life insurance guy, so I can only think about life. I'm a general insurance guy or health insurance guy, I'll only think about it. Okay, I am from mutual fund industry, I'll only think about financial goals and retirement purpose, right? If you don't constrain yourself with that, you have a decent understanding of all lines of business and keep customer at heart. And of course, have the technical skills to do it, right? So it's a combination of a few things. Both the technical skills from doing the financial models, technology skills to make it productized, built in the form of API, and understanding of lines of business while keeping customer at heart.
Right.
So it's a combination of a few things. And that
Yes. I mean, that's a very, very unique problem you are solving. So can people go on your website and see this report?
Yeah. So people can, so we, in fact, when we started as T2C.
Oh, okay.
So it was only, even though it was API first, it was only on the website. But we did not have the marketing dollars to spread the awareness. Second, we also understand that people are not willing to pay for advice, even though it's unbiased. People are not willing to pay for it. They want, what products should I buy, right? And when you talk about what products you should buy, there has an element of bias. And hence it did not take off. So we started giving away APIs to the sellers of financial products, insurance brokers, insurance companies, advisors, wealth advisors, and also build a layer on top of it where they could configure what products is relevant for a persona. Because they have a bouquet of products, right? They can sell it only from what they have.
Yeah.
And they have an understanding of what product would be suited for the persona.
Right.
While the size of the cover still comes from our engine, the rules for the product mapping comes from them, but it's part of the framework. So to answer your question, yes, people can go on our website, get the size, the financial needs analysis done. You can pay a small amount of money and it's available.
Great. Now let's talk about our Indian government want that everybody should be insured by 2047, right? That's a vision we are getting right now, right, as a country. So what do you think, like what all things regulatory should be doing? Are they doing some things right? What all things you found great they have done? Maybe would like to know your view around the same.
Yeah, so I think insurance for all by 2047, I think quite a few things need to happen, not just from regulator side of things, but also from industry side of things. And InsurTech will have a role to play. So I think for insurance for all by 2047, let's start with what insurance industry should do. Then we'll talk about regulators as well. So for people to be willingly buy insurance products, they need to have the trust in them, right? That if I pay a premium, my claims will be paid and my claims will be paid without much of a hassle. So that trust have to be brought back. Unless that happens, the mass adoption of insurance is very, very unlikely. The second is the general awareness about insurance, right? Not many people even know that, let's say, a product like home insurance exists, a product like disability insurance exists, right? Thanks to COVID, people now understand term insurance, health insurance, but there are many other products that are relevant. The risk exists, but people do not appreciate those products. So the awareness should also increase. The third part that insurance industry should consider doing is they're currently confined to tier 1. So you can't do insurance for all unless you go to tier 2, tier 3, tier 4, tier 5, and so on and so forth. So the business models would also need to be evolved. You can't deploy 2x, 3x, 5x, 10x number of people to scale the business. You probably would need to apply technology and make it a lot more relevant to the target audience. So insurance is the only industry where you have one product that is sold to pretty much everyone, right? But what applies to tier 2 may not apply to tier 3, may not apply to tier 4, right? So a tier 1 guy by definition would also understand a more complicated product, but a tier 2, tier 3 person may not. So one, you need to have product which is more aligned to where you're selling. Second, the distribution mechanism should also be more aligned, which means that can I sell you in the language that you understand? Can I sell you in the language which is comfortable to you? Some people are happy with chat. Some people prefer voice calls. Some people prefer videos. Some people prefer talking to individuals. So can I do hyper personalization, not just of the product, not just the size of the product, but also the delivery of communication? So text, video, individual, the voice, whatever mechanism makes sense to you. So the adoption of technology would become important. This is where I think InsurTechs will also have an important role to play. Talking about InsurTechs, I think it's important that insurance companies should be more agile in working with InsurTechs. Because InsurTechs are startups, right? At the end of the day, they are startups. They can't afford 2-3 years of go-to-market.
Right.
And 1 year to get for the first feedback. And the situation where you go live and realize that other functions were not even aligned.
Right.
Because if you're solving a problem on the tech side of things, even if you're solving, let's say, on underwriting side of things, the distribution team needs to know about it, right? The actual team needs to know about it. The claims team needs to know about it. The operation teams needs to know about it. So while InsurTech is only focused on underwriting, pretty much every function in most cases get impacted, and everyone should be aligned.
So there should be no silos, right?
There can't be any silos. So having a team which is cross-functional, which is actively engaging with InsurTechs, would then become very, very important. And so these are the things that industries will have to do. Insurance companies will have to do. Increase awareness, bring back the trust, adopt technology with some degree of agility, and ensure that there's a cross-functional team which is actively working on it. From a regulator point of view, I think there are two important things that need to happen. One, MGAs with a MGA plus reinsurance combination, not MGA plus insurer plus reinsurer. Because if an insurer is in the picture, insurance companies would also always think, okay, maybe this product would bring me, let's say, few crores of revenue in Indian context. But my overall books is 3,000, 4,000 crores, right? So in the overall scheme of things, this is very small and I may not want to put in effort. But with reinsurer giving the capacity and maybe some degree of expertise, and MGA is doing the heavy lifting, the go-to market could be very, very short. And it would require lesser effort to launch a product. For an insurance company, it has to involve actual team, marketing team, systems team, a compliance team to review the legal document. And unless the product can promise a certain scale, it doesn't become viable for them.
In India is very complicated.
And India is very complicated, right?
It's north, the south. I mean, every state is a new learning, right? Basically.
And the second part of change I think regulators should do is focus insurers. Maybe monoline insurer or insurer which is focused on one geography, let's say Gujarat, for example, right? Or Andhra Pradesh, for example. That would mean that those insurance companies would have also lesser capital requirement. So give license to companies which are, let's say, saying, okay, I want to sell, let's say, only motor insurance and only in Gujarat. Then the capital requirement should also come down, right? Currently, the capital requirement to start an insurance company, while regulator says 100 crore or 200 crores, but actually you need 500 crores to even get started, right? Which also means that you can't have insurance companies which are startup in nature, startup in mindset, because startup founders would not have that kind of money. But if you bring it down to, let's say, 25 crore, 50 crores, it then becomes easy to start an insurance company, which is a focus, which of course has boundaries, but then the innovation becomes a lot more easier, and there will be many more insurance companies, right?
And they can create a lot more value and very innovative features, right?
Yeah.
Which and very specific to that state, right?
Yeah.
Typically.
So, for example, if there is a product which can only become $1 million company, right? There's still a merit in doing $1 million company, which is of a certain scale, which has a certain limited number of limited expenses and a smaller capital requirement. But for an insurance company which runs at a certain scale, doing a product which only fetches, let's say, $1 million may not be a good idea.
Yes.
So, focused insurance companies with limited capital requirement is the second innovation or second relaxation that should happen from a regulatory side of things. And yeah, third leg is technology. Adoption of technology becomes very, very important. And this is where insurance companies need to take a call whether they do it in-house or work with focused startups who are solving a problem with a lot of focus and dedication. So the build versus buy mindset should also need to be reevaluated.
Right. And they will also have to think from how can we increase the penetration, right? Not just individual profits and individual growth, right? I think from an industry mindset, they will have to think, right? I think to bring in the growth, right?
Yeah. So the industry has to come together to make this happen. Otherwise, it may not be achievable.
And one more thing, right? I mean, our penetration was high, then again it came down, right? Then market is not increasing, TAM is not increasing, then we are catching each other's customer only, right? So I think it's a bloodbath then, right?
Yeah.
So nobody is gaining anything out of it, right?
Yeah. So the overall pie should increase, right? And that's what insurance for all means. I mean, if we're fighting for the same pie, maybe the customer would get benefited, but the insurance companies may not make money out of it.
Yes.
So the intention should be increase the overall pie, and how do you increase overall pie is what we discussed just now. Right?
Yes. True. And as this AI is disrupting the things, okay, if you are given a lot of money and every resources you want, you are given that, right? So what are some of the use cases that you work on? Or what are some of the problems that you feel can be solved greatly with the help of AI?
Yeah. So I think insurance industry is very data driven, right? For me to be able to, let's say, estimate your premium, I still need to know your age, still need to know your gender, still need to know your smoking habits, let's say drinking habits, any history that you have, family history that you have, your interest in, let's say, adventure sports. I need to know all of that to be able to estimate the risk and hence assign a premium. But where AI could help is how do you get those information? It could be a conversational thing. It could be a very direct question. It could also be use of alternative data. So, for example, if I am in a certain social strata and I'm also into adventure sport, but I do not have a passport, it's very, very unlikely that I would actually indulge in adventure sport. So if I, in a certain social strata, I know that there are safe places in the world to try an adventure sport. But if I don't have a passport, I can't travel. And hence my risk aligned to or risk associated with an adventure sport should be rightly adjusted. Equally, there are alternative source of data. For example, we were discussing this just before the recording, that you could extract a lot of information from, let's say, a video of my face, which earlier required, let's say, doing a blood test. So can I look at non-intrusive, non-invasive ways of capturing information and still not compromise on my risk?
So one selfie can insure you, right? It's as simple as that, right?
Yeah.
I mean,
so can I just switch to that, right? Of course, it would be a journey. It may not be exactly same as getting all the information in a policy document. But if you were to expand the market, we'll have to kind of make it easier for customer to get onboarded. For example, someone I know was trying to see if they could do hyper personalized product based on what they are shopping on Amazon, for example. So can I use their Amazon shopping history to position them the right products?
True.
So can I use that data? For example, one of the rideshare company in India had a product where if you are going to airport, they'll pitch you, do you want to buy a flight delay insurance? They already knew, right, that you are going to airport. And the decision to say yes or no becomes very, very easy.
I mean, it's a one click away.
One
right?
click,
I mean,
right?
I think yes, and done, right? I mean,
So how do you kind of use technology, how you use alternate data to reduce the cognitive load of the customer while not compromising on risk is how AI should be used. And I hope that more and more companies start using it. Because ultimately, while insurance company is at a certain stage, everything else around us is evolving, right? Amazon gives us recommendation, Netflix gives us a recommendation on what to buy, what to watch. Food delivery apps would give you a recommendation based on what we've been doing. But insurance companies assumes that we can continue with the same process, lengthy process, and customer would still do it, right? So the expectation of the customers are shaped not just by what other insurance companies are doing, but also what other industries are doing. And I think it's time that we start thinking in that direction, making customers' life easier while not compromising on risk. And this is where I think AI would become quite relevant.
one more thing you were saying, maybe when we were discussing, was in tier 2 and 3 cities, people are surviving, right? They are not having any spare money to spend on insurance, right? I think so. I think a customized plan can be built for them, and I think you said government is already solving that problem, right, with the help of Ayushman Bharat
Ayushman
and
Bharat, yeah.
those kind of initiatives, right? I think.
Yeah. So I think the irony is you start thinking about insurance only after you arrive at a certain stage in life. When you start realizing that you are an asset too, being not completely all right as a financial risk, and that happens after you arrive at a certain stage in life. But if you're not insured, and if an event happens, let's say we should talk about Ayushman Bharat, right? So the question around, and this is for, let's say, lower 50% percentile people of India in terms of economic status. Would they think about insurance? No, they're thinking about how can they get their next meal. So insurance is not their priority. But if an insurable event happens, would that impact them? A lot more than us, you and I, right? So in reality, they should be thinking about insurance much sooner than you and I. But as a human behavior, you're trying to solve the immediate problem, not a problem that may or may not arise in 5 years.
Right.
Right. So someone who earns, let's say, 5,000 rupees a month, if he or she were to get hospitalized where the expenses are, let's say, 50,000, it could bring them back like 5-7 years in their entire financial
Right.
life journey, right? But would they think about insurance? No. So that's where Ayushman Bharat becomes quite handy, right? But Ayushman Bharat can do only so much, government can do only so much, right? How do we make products which are aligned for these guys, where they're also made aware of it, it's affordable for them, and it's easy to buy, easy for them to buy, and they also get to trust that, okay, if an event happens, I'll be paid, right? So that's another layer of problem that needs to be solved if insurance for all needs to get
And one more thing we are seeing now, hospitals are also getting a insurance company license, right? And they have all the data and manufacturing, I mean, servicing in their hands, right?
Yeah.
Do you feel they can also contribute to this problem to good extent, or?
Yeah, certainly, and this is quite common in US, right? In India, it's happening now. But if you look at it, it's alignment of interest, right? If the entity that runs insurance company and the entity that runs healthcare company are two different entities.
Yeah.
Their interests are not aligned. Insurance companies would want to pay lesser claim amount, basically lesser medical bill, but hospitals would want to maximize it, right? I mean, if you look at from a short-term view, this is how the two companies are stacked or industries are stacked. But if you're a healthcare company or a hospital who also owns an insurance company, you will focus more on ensuring that the overall profit of both the entities is maximized. You're not maximizing on medical bill because that would impact the profit P&L of insurance company. You're not, and vice versa, right? So, and of course, you have a lot of data from OPD time of things, right? So, insurance company gets to know about you being sick only when you are hospitalized.
But there is also different pricing for different person, right? That is also happening. There is no standardization in hospitals, right? For example, for knee replacement for one customer, it will be charged 3 lakhs, and for other it is 5 lakhs, right? Basically, so that standardization is also not there, right? I mean that maybe can be controlled by them, right, in some extent.
Yeah. So let me just finish that thought.
Sorry. Yeah.
So if you're a hospital company that also owns an insurance company, then you get to know about your customers right from the time he starts taking, let's say, first medicine. He may not be ill enough to get hospitalized, but you get to know, okay, something is not right. He's taking some medicines regularly, right? And then you could do preventive actions around it so that the medical bill or the hospital bill is minimized. So then it works in an overall benefit of the customer, as long as you're trying to maximize the profit of both the companies and looking at long term, right? In terms of the professional charges for the same ailment, I think those are largely discussed and pre-agreed by pre-negotiated between hospitals and insurance companies. But which hospital do you go to could have a difference. What other comorbidities that you have could also have an impact. Someone who is also suffering from, let's say, diabetes might just take, let's say, theoretically might just take longer time for another surgery, right? Because it has to be controlled, taken more care of. So those are the reasons why the differences would arise. But for two exact set of people going to same hospital covered by same insurance company, I think there shouldn't be much difference.
Okay. We have seen global markets has seen a great growth in insurance, and India is not there yet. So what do you see the reasons for the same?
Yeah. So I think one thing is per capita income, right? If you look at more developed markets, the US has per capita income of $80,000, $85,000 per year, right?
But insurance is also not cheaper there, right?
Insurance is not cheaper.
And more tight there, right?
Yeah.
More.
So one thing is, and India has about $2,000, right? So when you're struggling for your basic amenities, you're not thinking about insurance. Insurance then becomes a luxury. People like you and I who have achieved some sort of professional success, and when you start thinking, okay, what if this goes wrong? What if that goes wrong? And all of these needs to be covered, right? It's only then you start thinking about it. While in more developed world, insurance then becomes important because if that is not taken care of, you tend to pay. You've seen enough instances of people paying a lot of money because of insurance events happening, right? So that's one reason. Just that the economy is not at a stage where people are starting to think about insurance. The other challenges continue to remain: the trust, the awareness. Those continue to remain, and I think those need to be solved for. The delivery of it, insurance companies still focusing on tier one. That's another challenge. It's time that the pie is increased. The use of technology, right? So we've not built systems and technology or using technology or alternative data to be able to sell it meaningfully to people sitting in tier 5 while still being confident that I have all the information that is required, right? So starting from people not being able to afford it to trust, to awareness, to the use of technology to do products which is more aligned to the people you are selling, right? These are some of the reasons. And I think as with economy getting better, per capita income increasing, some part of it would be naturally taken care of. But a lot needs to happen on the trust and awareness and hyper personalization piece of it.
Another question is how can the InsurTech and insurance companies can work together, and how actuaries can play a role there?
So, InsurTech, if you think about it, they are tech startups who are trying to solve a problem on one part or two parts, multiple parts of insurance value chain. Some are trying to solve problem only on the distribution side of things, some are only on the underwriting, some on the claim side of things. So the intention of InsurTech is to add value to a certain part of the value chain, which should eventually either increase in top line or in the bottom line. That's the only way an InsurTech could add value. And the only way InsurTech could scale is by collaborating with insurers. So they have solution, but the solution to start making impact, they have to collaborate with insurance companies, right? So this is underlying premise of InsurTech. The end goal of an InsurTech is to either collaborate with an insurance company or become one. In terms of actuaries, so most InsurTechs, at least in my experience, they are great at tech, but tend to have limited domain knowledge. And there have been instances when I've seen examples of InsurTechs trying to solve a problem which doesn't need to be solved. So actuaries from that lens could help do multiple things. As a consulting actuary, you could help them in helping them solve the right problem. So eliminating the problems that don't need to be solved. Second, quantifying the impact of the problem that they're solving. So InsurTechs in their own world could think that they're going to change the insurance industry. But in the overall scheme of things, it would move, let's say, the profit percentage by a few basis points.
Right.
So being able to quantify it then becomes important. And then once you know what is the impact that you bring, you could also then price yourself as an InsurTech, because you could only charge a fraction of the value that you bring.
Right? Yes.
So actuaries could also help them in doing that. Actuaries could also help them in speaking them in a language that insurance companies understand. Because as a tech company, you are trying to solve a problem, but how does insurance company know what part of the value chain it's impacting, and what part of whether it's increasing your top line, bottom line, does it increase, does it help in persistency, does it help in shorter underwriting, does it help in shorter sales cycle? So insurance company need to know what part of their drivers is being impacted. So speaking in their language could also become quite relevant. And as a consulting actuary, you could also, so actuaries, thanks to the good work the actuaries have done in the past, are seen in a certain light. And typically when actuary recommends an InsurTech, the decision makers would be at least willing to listen for the first time, because that's the credibility actuaries in general have achieved, right? So in that sense, actuaries could also help open the doors for InsurTech companies, which is very, very relevant. But actuaries working in an insurance company, they could also bring a lot of value. I think every insurance company that evaluates an InsurTech should also have one of the members in their team as actuary, because we tend to look at every part of the insurance value chain. We are able to quantify the value it brings. And we then also remain ahead of the curve in terms of what's happening in the technology, and see if it requires any changes in how we price, how we design products. So these are some of the ways actuaries can also get involved in an InsurTech setting.
Yeah, that's great. Yeah, definitely they can work together in great way and create great value in industry. Okay, so thank you very much, Sumit, for joining us and then sharing great insights around distribution, actuary, and Vision 2047. So thank you very much for joining.